Hello and welcome back to our channel. After a brief hiatus in our last video where I shared the happy news that the new, updated and upgraded version of my workbook Live on Less, Invest the Rest had been published, today we get back to our free course in effective financial literacy. And we go back to looking in more detail at property again. This is actually the third in our series of videos on property. In our last two videos on the topic, we looked at how important it is to think about real inflation in any assessment of whether you're making a real return in a property asset. And we also looked at the difference between money and real wealth. And in the second video in our series, we looked at the idea of relative value. I explained why these sorts of considerations are actually really important when you think about any property investment, and how all too few people do, including many estate agents. So we saw just how important inflation and relative value are when considering the true value of property. There are two other key valuation metrics that we should be aware of to give us the best chance of working out whether properties are cheap or expensive. And these are something called rental yield and also the ratio of property prices to salaries. So today we move on to look at the first of these, namely rental yield. And we'll also consider the impact of capital growth, the cost of money, tax, and the key point that you can borrow money to buy property, unlike most other assets. So, one of the most useful ways of trying to work out if a property is truly cheap or expensive at a fundamental level is the percentage return it might generate for you if you were to rent it out. This is called rental yield. Working out rental yield is a pretty simple calculation, but it's one that surprisingly few people make when considering the purchase of a property. I've even met estate agents in London and New York who had never heard of the idea of rental yield, which to me is a bit like a doctor never having heard of a heart. Anyway, quite simply, rental yield is the number you get if you divide the assumed annual rental income from a property by the assumed value of that property. This is a number that you can then use to compare the potential returns on a property to any other asset you might be thinking about, including shares or other properties. It can also give you an idea of whether a property is cheap or expensive at a fundamental level, because high rental yields suggest that a property might be cheap and low rental yields that it might be expensive. So let's use an example to explain, and let's assume you own the £500,000 property that we've been looking at in our last two videos. Then assume too that you're able to rent it out for about £2,000 a month, so that would imply you can make £24,000 a year of rent from that property. This would then be the gross rental income. Expressed as a rental yield, we would say that this property is generating 4.8% of gross rental yield for its owner by dividing that £24,000 a year of rent into £500,000, the value of the property. Bear in mind, however, that as a landlord, you will usually have to spend a certain amount each year on the maintenance of a property and on fixtures and fittings. And there's also a chance that your property will lie void, i.e. be empty, from time to time if you can't immediately find a tenant to replace one who has left. Both of these things will have a negative impact on your rental income. And as such, if you were sensible, you might prudently assume that a rental property will be void, say 1 month a year on average over time, and that annual expenditure on maintenance, fixtures and fittings might be roughly another 10% of the gross rental income. So continuing with this example, this would mean that the net rental income from the property is likely to be more like £19,600 a year. You take the gross income of £24,000 and subtract 10% for wear and tear, which is £2,400, as well as 1 month's rent for potential void periods, so that's another £2,000. And this gives you a net rental income of around 3.9%, which is what you get if you divide that £19,600 into £500,000. So this number is very useful, as you can now compare it to the interest you might get on a savings account, the return you might make on another asset such as a share, or the return on a different property. And crucially, of course, the rental yield is not the whole story. When we consider how good an investment a given property might be, obviously we will also need to consider potential capital growth, i.e. the chance that the price of the property will increase. So using the same example, imagine that the price of that property increases by about 5%, going from £500,000 to £525,000 in 1 year. In this example, the return from the property is 3.9% from net rental income and 5% from capital gain. So we can say that a simple calculation of the total return from the property in that year is therefore about 8.9%. So that's not bad, except that if you've watched this video series, you will no doubt have realised that there are a few more pieces of the puzzle to include in our calculation before we can be confident that we have the right number. And the first thing we need to think of here is inflation. Because if we don't, then we're suffering from something called money illusion, as I've explained in many of my videos in the past, which is not accounting sufficiently or often at all for inflation. So if inflation is also 5%, say, then your capital gain in this example has actually only kept pace with inflation. A simple calculation of the real return you might make on a property should therefore be net rental yield plus capital gain minus inflation. And so in this example, this gives us 3.9% plus 5% minus 5%, which comes out at 3.9%. And without wanting to complicate things too much, also bear in mind that inflation will affect the value of your rental income throughout the year. With inflation at 5%, for example, the £2,000 of rent you receive at the end of that year is worth about £100 less than it was at the beginning of the year. Your real return is therefore a little bit lower still. And you may already have thought of yet another thing to be aware of: tax. Wherever you are in the world, there will more than likely be various property taxes, particularly for investment properties. These might include tax on any income you make from the property, tax on the capital gains you make when you sell it, and in plenty of places, annual taxes based on the value of the property too. So to ensure you have an accurate idea of the income you might be able to generate from a property, and by extension, what it might therefore be worth, you will need to take these into account too. And then there is the cost of money. Perhaps most important of all, most people will need to borrow money from a bank in order to buy a property. And when you take out a mortgage, you have to pay interest on that money, obviously. So to keep the maths easy again, in the £500,000 example we're using here, let's say you might have bought this property with a £50,000 deposit in cash and then borrowed £450,000 from the bank. If we assume the interest rate on that mortgage is 5%, then you'll be paying the bank £22,500 in interest payments each year. That's 0.05 times 450,000. And that's £1,875 a month. Your real return, after accounting for inflation and the cost of money, is actually going to be negative in this example. You're making £24,000 of rent, subtracting £4,400 for void periods and wear and tear, and paying £22,500 of interest on your mortgage. And this doesn't include any assumption for the taxes you might have to pay either. Of course, very often the real return on property has been positive. If rental income and or capital growth are a good deal higher than in this example, then you have a good chance of making a solid real return on property. But this doesn't always happen. And far too few people really think properly about inflation in my experience. Of course, one very important feature of the property market is that it is the one financial asset that most private individuals can borrow a lot of money to buy. And this means that if property values increase in real terms, you can make a great deal of money, as lots of people have in many countries in recent years. And this is because borrowing gives you leverage or gearing, which basically just means using debt to buy something. So to explain that, using the same example again, where you've invested £50,000 of deposit of your own money and borrowed £450,000 to buy a property from the bank, imagine now that this property increases in value by 10% to £550,000. This means that you will have actually doubled your £50,000, because if you were to sell the property for £550,000 and pay the bank back their £450,000 mortgage, you would have £100,000 left over. In this example, you have made 100% on your money because you've turned your £50,000 deposit into £100,000. Crucially, you've made this fantastic return even though the property itself has only increased in value by 10%, from £500,000 to £550,000. And this is obviously great, and a big part of the reason that lots of people love to invest in property, because the bank is essentially helping you to make a much bigger return by lending you enough money to buy something you could otherwise not afford. Said against this, however, it's really important to consider what happens if the price of the property does the precise opposite. If this property were to fall in value, say to £450,000, crucially, you will have effectively lost all of the £50,000 you invested. So in this example, even though the property itself has only fallen in value by 10%, from £500,000 to £450,000, you have lost 100% of the money you put into it. And it's really important to understand this aspect of property investment. Being able to borrow money from the bank is absolutely a double-edged sword. It can magnify your potential gains, but it can do the same with your potential losses. And this is why it's really important to understand all of the things that we're covering in these videos before you take the large step of buying a property. And perhaps the most important thing of all to understand, which is very poorly understood, is this difference between nominal growth in property prices and real growth, which is growth after you've accounted for real inflation. If a property has doubled in price over a few years, but the value of money has halved over the same time period, you will have achieved nominal growth of 100%, but real growth in your actual wealth of 0. And all too few people understand this reality when it comes to property investment. The other important thing to understand, which I mentioned in the previous videos, is just because things have been a certain way for many years, absolutely does not mean they will always be that way. If interest rates and inflation are higher in the future than they have been in the past structurally, property returns could be much lower and possibly even negative in real terms. This has been the case in many times and places throughout history and is something you're going to need to be very careful about, particularly if you're going to borrow lots of money from the bank. So that's it for today. In our next video in this series on property, we'll move on to look at the ratio of house prices to salaries and the important role played by demographics. And then using all of these ideas from these 4 videos, we'll then look in more detail at the controversial topic of renting as against buying, and also in a little detail at how much you should theoretically spend on putting a roof over your head in an ideal world at least. As ever, if you want to ensure that you're one of the first to see these videos when they're published, please do click the subscribe and bell buttons, and please do also consider subscribing to our free email service direct from the Plain English Finance website. And as I always say, if you'd like to hear from me more regularly than once a fortnight in these videos, please do feel free to connect with me on any or all of LinkedIn, Facebook, and Twitter or X. Hope you found that video vaguely interesting, useful. We've got at least one more to come on property. And until then, I wish you the very best.